We've learned that revenues are not always recorded at the same time as the exchange of cash. Cash can be received before, at, or after the registration of revenues. Why is this so? Is this an important accounting principle? Well, yes, it is. It's called accrual accounting, and it ensures that a firm records its economic operations in the period when they have been carried out. In other words, revenue is recorded when it is earned, and costs are registered when they are incurred. A company's income statement will contain revenues related to products or services that have been transferred or delivered to the client, regardless of when cash is received. In the same way, costs will be registered in the period when they have been sustained and not in the period when they have been paid. We have already seen the mechanics of these transactions. Let's formalize these concepts by describing the 4 categories of accruals. These categories are unearned revenue, accrued revenue, prepaid expenses, and accrued expenses. Unearned revenue will be registered in situations when we receive payment for products or goods that have not been delivered to the client. For example, a construction company will register unearned revenue when it receives an advance payment for a house that has not been built and delivered to the client. The money is in the firm's bank account, but it has not carried out the required service. Therefore, the company technically owes the money to the client, which is why unearned revenue is a liability. Later, when the house is ready and is delivered to the client, the company will erase the liability from its balance sheet and record the amount as revenue. On the other hand, accrued revenue applies in situations when a firm has provided goods to a client but has not received payment for these goods. Given that the goods have been delivered, it is correct to register revenues in the income statement. At the same time, the company expects a payment for its services, and this will be shown through an increase in trade receivables. When the client pays for the goods, trade receivables will decrease and cash will increase. Very well. The next 2 types of accruals follow the same logic, but are related to expenses. Prepaid expenses are recorded when a company pays some of its expenses ahead of time. The firm sends an advance payment for a service that will be obtained in the future. This is a cost that will be sustained in the next few periods, but has already been paid. Think of the office rent that a company pays. In a given situation, it could decide to prepay rent for the next 6 months. The money goes out of the company's bank account in exchange for the right to use the office space for the next 6 months, right? Cash decreases and prepaid expenses are registered on the company's balance sheet as an asset. Prepaid expenses are an asset because they are something the firm owns. It owns the claim to use the office that it will rent for the next 6 months. Finally, we have accrued expenses. These are expenses that have been incurred but have not yet been paid. Think of a soft drink producer. One of the main ingredients in its products is sugar. The company buys sugar from suppliers and pays these suppliers in 90 days. It uses the sugar to produce soft drinks and hence incurs an expense, but doesn't pay for it before 90 days have passed. An expense will be registered in the income statement because the sugar has been used in the company's production process, and a liability will be registered in its balance sheet, given that it still owes money to its suppliers. Later, when the company pays the money to its suppliers, we will have the following accounting entry: credit cash and debit accrued expenses. The main idea behind accruals is that an accounting entry needs to be made as soon as we provide a product or a service, incur expenses, or exchange cash. This ensures that revenues and expenses are recognized in the correct accounting period.